Topic examines non-deposit liabilities and the available funds gap, which are critical concepts in bank funding and liquidity management. Non-deposit liabilities are funding sources obtained outside traditional customer deposits and include interbank borrowings, repurchase agreements, commercial paper, subordinated debt, federal funds purchased, and long-term bond issuances. Financial institutions rely on these sources to supplement deposits, support asset growth, and manage short-term liquidity needs. However, non-deposit liabilities are generally more sensitive to market conditions and investor confidence than retail deposits. The topic emphasizes that excessive dependence on non-deposit funding can increase refinancing risk and liquidity vulnerability, particularly during periods of market stress or financial instability. A key concept discussed in the topic is the available funds gap, which measures the difference between a bank's asset growth requirements and the funding available from stable deposit sources. When loan demand and investment activities expand faster than deposits, institutions must rely on external funding markets to close the gap. The available funds gap therefore reflects the extent to which banks depend on non-deposit liabilities to finance operations and growth strategies. The topic explains that managing this gap is essential because reliance on volatile funding sources may expose institutions to refinancing pressures, rising borrowing costs, and sudden liquidity shortages if market conditions deteriorate unexpectedly. The topic further highlights the relationship between non-deposit liabilities and liquidity risk management. Short-term wholesale funding markets can provide flexible and efficient financing under normal economic conditions. However, these markets may become unstable during periods of uncertainty when lenders reduce exposures or increase funding costs significantly. Institutions relying heavily on overnight or short-term borrowings may face severe rollover risk if counterparties refuse to renew funding arrangements. The topic emphasizes that diversified funding structures, liquidity buffers, and contingency planning are essential for mitigating the risks associated with non-deposit liabilities. Effective funding management therefore requires balancing profitability objectives with funding stability and market resilience. Topic also focuses on the choice and cost of non-deposit sources of funds, which significantly influence institutional profitability and liquidity strategies. Financial institutions evaluate funding alternatives based on availability, maturity, flexibility, collateral requirements, regulatory treatment, and interest costs. Short-term funding sources such as federal funds borrowings and repurchase agreements generally offer lower costs but expose institutions to greater refinancing risk. Long-term debt issuances provide more stable funding but usually involve higher borrowing costs. The topic explains that funding decisions depend heavily on market conditions, interest rate expectations, asset liability structures, and institutional credit quality. Successful funding strategies require aligning funding characteristics with operational and liquidity management objectives. An important aspect of non-deposit funding management involves understanding how market conditions affect borrowing costs and funding accessibility. During stable economic periods, institutions with strong credit quality may access funding markets efficiently at relatively low interest rates. However, financial stress, declining credit ratings, or market volatility can increase funding spreads and restrict access to financing sources. Collateralized borrowing arrangements may also require higher haircuts during stress conditions, increasing effective funding costs further. The topic highlights that institutions must evaluate both explicit interest expenses and indirect costs such as collateral requirements, operational complexity, and liquidity constraints when selecting non-deposit funding alternatives. The topic concludes by emphasizing the strategic importance of managing non-deposit liabilities within broader liquidity and balance sheet management frameworks. Financial institutions must maintain diversified funding sources, monitor funding concentrations, and evaluate refinancing risks continuously to preserve financial stability. Regulatory frameworks such as Basel III reinforce the importance of stable funding structures through measures like the Net Stable Funding Ratio and Liquidity Coverage Ratio. Institutions that rely excessively on volatile non-deposit liabilities may face greater vulnerability during financial crises, while those maintaining balanced funding profiles are better positioned to sustain operations under stress conditions. Effective management of non-deposit funding therefore supports profitability, liquidity resilience, and long-term institutional stability.